We're moving on with our liabilities discussion to talk about payroll. Payroll, obviously, most people know by this point, comes from work that employees do, and there are taxes that are associated with that, both withheld from the employee's paycheck, but also that the employer is required to pay in addition to that. So we've got the gross pay, which is what the employee has earned, and from that comes federal income tax, state, there may be some voluntary deductions for health insurance, things like that. And then two categories that are really, they used to be one way back in the day called FICA. And at some point, I don't know, in the past couple of decades, they broke FICA down into two separate categories. One is Medicare and one is Social Security. And these items taken together are removed from the employee's paycheck, or from their gross earnings, I should say, and what the employee gets is known as net pay. So as I mentioned on the prior slide, FICA is broken down into two distinct taxes, Social Security and Medicare. The Social Security, the percentage remains the same and has for many years, but the limit for wages that Social Security is paid against changes every year. So what I happen to have in here is the 2020. And to simplify what I'm saying, if you have an employee that makes $140,000 a year, they are only going to pay Social Security in this 2020 example of the first $137,700 that they earn. So once they hit that Social Security cap, the wages above that are not subject to Social Security tax. The Medicare tax is 1.45%. There is no cap on that. It applies to all wages. And that's probably why they split those categories up, so that it would become more obvious when an employee had hit the cap and was no longer paying Social Security. Now, the other thing I want to draw your attention to is that employers must pay these withheld taxes to the Internal Revenue Service. So the employer is taking this money out of the employee's paycheck and setting it aside. Just like our discussion with the sales tax, you do not ever, ever, ever want to commingle withholdings from employee pay with any other operating funds. So there should be an entirely separate account. Every pay period, employees are paid, and the tax withheld gets held in this segregated account. We don't dip into that. If bills come due and revenue is short, it is sacred, because the person individually, and it can just be an employee or a bookkeeper, somebody without any ownership interest in the company, if that person is in charge of making sure that that money goes in and they don't do that, they can be personally held liable. And there are actually insurance policies that people who are in a payroll capacity can take out to protect themselves in the event that somebody dips into the account and the money isn't there when the payroll goes in, or should have gone in to the government. And depending on how the size of the payroll depends on how often that money needs to go to the government. Now, you may hear me say the word deposit from time to time when I talk about remitting payroll taxes, and that's an old term. We don't actually deposit money anymore the way that it used to work. And the only reason I'm talking about this is you may still hear people talk about this because it hasn't been this way for that long. I happen to have still in my desk a deposit coupon book that used to be the IRS used to issue these, and you would go to your bank when with all of your employees withholding and any of the employer match, which I'll talk about in a minute, and you would fill out these little coupon books, and there's a little area here where you can bubble in the specific tax that it's for, and you would take those to any bank that was a federally insured depository institution, and they would take the payroll tax and give you a little receipt. And as I said, depending on the size of your payroll, you might have to remit that money 3 days after payroll. There are longer periods for smaller, but if you're a mega employer, that the government wants their money immediately. They're not going to let you sit on that money and maybe earn interest on their money. They want it from you. If, at least as of the current law or rules on this, if the total tax to be owed in an entire quarter doesn't exceed $2,500, then you don't have to send that money in until the return is due. Returns are filed quarterly, and so if it's the total amount withheld and owed is less than $2,500, that money can go with the return. If it is more than $2,500 and you send it with the return, you're going to get a penalty for failing to, they still call it deposit, but now it's all done electronically, and it's an electronic funds withdrawal right from the bank account. So in addition to the FICA and Social Security tax that we withhold from our employees' checks, there's also federal income tax and state, and depending on where you work, there may be also local income tax as well. The amounts for these will vary depending on a number of allowances that an employee has claimed. There is a Form W-4, and the employee fills that form out and tells the employer, I'm single, I'm married, and these are the number of allowances that I'm claiming, and there's a little worksheet. As the employer, you take that information and you set up the employee's payroll based on what their W-4 form has for allowances and marital status. So unlike the FICA and Medicare, where it's the same percentage for everybody, federal and state, it's going to vary from individual to individual. As I mentioned, you may also have voluntary deductions. You might have union dues, health insurance. There are companies that set up a United Way campaign, so you might have $1 or $2 or something going to the United Way. It's also possible that an employee has set up an automatic deduction to go to their credit union for their car payment, for example. So there are all kinds of things depending on what the employer is willing to do that an employee could have voluntarily taken out of their paychecks. Here is what a typical payroll journal entry is going to look like. We've got our salaries expense. So that's going to be the gross pay. Then we're going to record all of these liabilities. So we've got our Social Security, Medicare, our any income tax withholding, well, not any, but there certainly should be income tax withholding, any medical insurance that we're withholding that is the employee's responsibility, union dues, and then salaries payable that's going to be the net amount. And we're going to do this on the last day of the payroll period. This isn't necessary, well, we're not actually paying them. We're just recording the liability at the end of the pay period. Then payday rolls around, in this case, the very next day, and we're now actually going to pay this money to our employees. So we've got a salaries payable debit to reduce the liability to the employees, and then we've got cash to show the reduction in cash for the money going out to the employees. I'm actually going to stop this video and hop on to the next one to talk about the employer side of payroll.